Let's talk about the Fed.
Yeah, well,
we thought it was going to be good. It was dovish. Bad news is good news, but the stocks aren't reacting in that way.
Yeah, and it was more dovish. I mean, if you think about it, we really got a Fed that downgraded 2019 to 0 hikes and maybe one somewhere out there in 2020. But the reality is that this is a Fed that told you we're going to be more than patient, as we like to talk about. So look, what was the fallout, or what's the follow through? I mean, first of all, you saw that the dollar really caved, and I think if you look at central bank differentials around the world, I think the dollar, which traded through the 200-day, although the dollar index is back up a bit today, that's very good for reflation trade. So the irony is that you've got a dynamic where the Fed is, rates are now 250, 251 on the 10-year, and yet you've got this sense that, look at copper, close to $3 today. Crude prices continue to go higher. So, I think for equities, the concern certainly has to be when you hear the Fed that dovish or really that cautious, that much of a downgrade on the economy, people are worried about growth. That's the other side of this coin. You can't have low rates and a very strong economy all at the same time.
All right, Tim, low rates are one thing, and 2.5% for 10-year, yeah, that does catch headlines. But let's talk about the fact that German bunds on the 10-year side of things are just about break even right now, meaning no yield, maybe even negative in certain parts of that curve.
Right.
So how exactly does that play out relative to U.S. Treasuries? How does that change the dynamic of flows of capital kind of in developed economies around the world at this point?
I think in the short to medium term, look, we've seen this before, actually. And I think, you talk about differentials on central banks. ECB, Fed, I think at this point in terms of policy, it's about the same. But obviously where the ECB has been more extreme on the long end and they're essentially pushing down yields across Europe, we've also seen how volatile that can be because, in fact, over the course of a couple bouts over last summer and even earlier, you could see how quickly Italian yields can blow out. But look, the bottom line here is I think you've got a global setup where capital flows are not really going to change dramatically. If anything, I think right now, you look at credit spreads, look at leveraged loan indices in the U.S., which people were very concerned about in December. Look at the things that were signs of risk. Look at dollar yen. I think right now the Fed has once again at least put into the markets. And I think for equity investors, that allocation is probably now more towards higher growth stocks, at least those that have been defensive in lower growth environments. And I think that's big cap tech. I think for the industrial trade, which had outperformed for much of the year because it was a value trade and it was one that was at least starting to see some snapback, I think that might be part of the collateral damage if you're looking at equity allocations here.
All right, Tim, just a few moments left here. What about the financials? They were leaders to the downside yesterday with the rate decision. What is the outlook for banks?
Look, banks on fundamentals, to me, look actually quite interesting. It's a group that now is paying a dividend yield close to 2%. We talked about where the 10-year is, and so on an earnings yield basis, banks make sense. The balance sheets are fantastic. The multiples really have you almost at recessionary economy. But I think banks will struggle here. I think people are looking for some of that impetus on the net interest margins, and I think we'll be there.